Okay. This is going to be the final question we are solving on complex group structure, financial statement. So right after this question, we are going to do consolidated statement, consolidated cash flow statement, and we will say goodbye to consolidation. So let's see what we have here. Requirements of the question first. Prepare a consolidated statement of profit or loss and other comprehensive income for the year ended 31st April 2014 for the Marchant group. Hey, it's not Marchant, it's Marchant. For the Marchant group. And then II. Explain with suitable calculation how the sale of the 8% interest in Nathan should be dealt with in the group statement of financial position. Now again, before I go, there was something I wanted to bring to your notice quickly on the intergroup trading issue. Now, with intergroup trading, for instance, if we say P sold goods to S, P is the parent, S is the subsidiary, at $300,000, P bought the goods at, let's make this 500, and P bought the goods at 300. Half of the goods are still in stock of S. So how do we go about it in relation to the treatment? There are two ways we can go about it in relation to the treatment. What it simply means is that the sales given is 500,000 when we less cost of sales of 300,000 or 300, so 500, 300. Provision for our profit is what? 200. But we are told that half of the stock are still what? In stock. So provision for realized profit will be what? Half of the 200, right? And that's going to be 100,000. So how do we account for this? The first thing we said was that we need to cancel the sales in the first place. So in cancelling the sales, double entry for the cancellation of the sales, we're going to be debiting sales with the 500,000 and then credit the cost of sales with also 500,000. So that is the double entry for the elimination of the transaction. Number two, the unrealized profit 100,000. How must we account for it? We said that the unrealized profit must be subtracted from inventory. Hence, we're going to be debiting cost of sales with 100,000 and then credit inventory with 100,000. It means technically what we are doing was or is to debit the sales with a whole figure of 500,000, credit cost of sales, credit inventory. So we are crediting inventory with 100,000 and the balancing will be credited to cost of sales. So this is how we account for the intergroup trading. Get this once and for all. So we subtract the whole figure from cost of sales, add the unrealized profits to cost of sales. So technically, cost of sales will have a net reduction of 400,000. So that is something I wanted to bring to your notice quickly before we proceed to cost of sales. Okay, so let's go on with our question now. So the following draft financial statement relates to Marchant, a public limited company. Relates to Marchant, a public limited company. Marchant Group. So draft statement of profit and loss and other comprehensive income for the year ended 30th April 2014. So we have Marchant, we have Nathan, we have Option. We've been given their sales and everything provided there. Let's go to the next page, and that is where the journey begins. The following information is relevant to the preparation of the group statement of profit or loss and other comprehensive income. On 1st May 2012, Marchant acquired 60% of the equity interest of Nathan, a public limited company. The purchase consideration comprised cash of 80 million, and their fair value of identifiable net assets was 110 million at that date. The fair value of non-controlling interest in Nathan was 45 million on 1st May 2012. Marchant wishes to use the full goodwill method for all acquisitions. The share capital and retained earnings of Nathan were 25 million and 60 million respectively, and other component of equity was 6 million at the date of acquisition. The excess of the fair value of the identifiable net assets at acquisition is due to non-depreciated land. What does that mean? So we can begin with a group structure and put Marchant there. I don't know, I'm seeing Marchant, but I'm pronouncing Marchant. And the first level we go is this, and that is Nathan, and we are acquiring how many percent? 60%. So NCI is going to be what? 40%. Good. Then, as I'm working, I'm going to be working alongside. So, because we are preparing the statement of profit or loss account, we don't need to prepare the net assets. I hope you are getting the idea. So, step 1, group structure. Step 2, goodwill. So, see how goodwill will be calculated for Nathan. The other company will come here. Percentage. We are working in millions. How much did we pay? Fair value of consideration. 80 million. Okay. And that represents 60%. NCI will come in with 40%. Non-controlling interest. Were we given the value of non-controlling interest at the date? 45. So total value of the business is what? One, 2, 5. Were we given the net asset as at the date of acquisition in the question?
Yes.
As how much? 110. So, when we subtract, goodwill will be what? 15. So, that is first level. As I mentioned, these are easy marks you pick up in the exam hall. Next one. So that is the first aspect of note I. We begin with a group structure, we calculate the goodwill in Nathan, right? I like to do it like that so that as I'm working and I'm working. Next one. Goodwill has been impaired, goodwill has been impairment tested annually, and as at 30th April 2013 had reduced by 20%. Now, this is where I want you to listen carefully, because this is where IAS 38 comes in. However, at 30th April 2014, the impairment of goodwill had reversed and has already been included in the above draft financial statement of Marchant prior to the preparation of group accounts. Mepaucho, what does that mean? What does it mean? Someone should give me an interpretation of what we just read. Me too. We've been trying to try.
You have to do an adjustment.
Adjustment. So let's go. What adjustment do we do? Now listen carefully. Let's read it again. Goodwill has been tested annually and as at 30th April 2012. Now, when was the acquisition? 1st May 2012. So if as at 30th April 2013, that means what? After year 1, right? So if you check, the year ended for this question is 30th April 2014. So now, so goodwill at acquisition. Now I want you to stay with me here carefully. Goodwill at acquisition is 15. Closely. Then we are told that it has impaired by how many percent? 20%. As at what? The date. So impairment is 20% of Ebaze 15 million. What do I have? 3. So when I less it up, how much do I get? 12 as goodwill. Now TBB. Then the examiner said, however, as at April 2014, when the current year ended under consideration, the impairment of goodwill had reversed and goodwill was valued at 2 million above its original value. So this is my question. So what is now the goodwill? As at 30th April, per the company's decision. Elia has a tail. 17 million. 17 million. I don't know if you see that. Because the impairment of goodwill had reversed and goodwill was valued at 2 million above its original value. So the original value is 15. So they have valued it 2 million above, which is what? 17 million. But listen, have you heard goodwill being revalued upward before? So what do you think will cause the company to make this decision? What do you think will cause the company to make this decision? What do you think? It means that this is as a result of IGF, internally generated goodwill, IGG. Now, this is where IAS 38 comes to be. According to IAS 38, intangible assets, an entity is prohibited from what? Recognizing internally generated what? Fund. So, if anything, goodwill must be carried at its value after impairment. Hence, the extra $5 million would have to be what? Written off as expenses for the current year under consideration. What you say? Yes, madam.
Nhyira, I have a question. 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 I have a question. Before we even come to the goodwill side,
Okay.
it was saying they were giving us some value of the net asset. They give us share capital, they give us retained earnings,
Yeah.
and they give us other component of equity.
Yeah.
So, and it still relates to Nathan. So, in the net asset computation, what is happening to that? Because he said those are the values at acquisition.
Yes, and we were also told that and fair value of identifiable net assets acquired was 110 million. So we will use the 110 million because these are the fair value of the assets that we acquired.
So does it mean the rest are just there to confuse us?
Not there to confuse you. It is there just to give you a further understanding of the capital structure of Nathan. So listen, the share capital and retained earnings of Nathan were 25 million and 60 million respectively, and other equity was what? 6 million after the date of acquisition. Now do this. 25 plus 65.
Plus 6, it gives you 90.
Plus 6.
96.
96. NRT. Or say the excess of the fair value of the identifiable net asset at acquisition is due to non-depreciable what? Land. Which means their fair value is still 110, but fair value adjustment at acquisition 4. So that's why the 110 will be used. So it is not there to confuse you.
I'm there to confuse. Because I was confusing the two because when you add or it doesn't agree with what they've acquired.
But if you read the final statement, it agrees. I about reading, no? What I said? If we read the last part well, then we will get it. This is the build-up. So this is why I want you to pay close attention to the various transactions here. So it is not there to confuse you, but it is there to confirm. Because when we are bringing net assets at acquisition in the computation of our goodwill, we bring net assets including fair value adjustments. Yes. Their total net assets is actually 96, but the examiner said any excess is because of what? A land, which is not depreciated. In the end, they NHYIRA quote. Are you okay now?
Okay.
Or something else?
Yes.
Okay.
And the second one. So here you are seeing that we've computed the goodwill, and now we are preparing the financials at the end of 2012.
No, please. 2014.
2014.
Yeah.
So that is from 1st April, from maybe 1st May. 1st May 2012 to 30th April
2014.
2014.
Yes.
So it means a year before, that's where the goodwill reduced.
Yeah, because goodwill will come after a year, isn't it? Sorry, impairment of goodwill will come after acquisition. So at acquisition, goodwill is 15 million. So this impairment occurred when? Look at the dates there. Occurred when? 30th April 2013. Anamibwa?
Yes.
That is 1 year after the acquisition. So in the second year of acquisition, which is the 30th of April 2014, they said they are reversing this thing. And now they are increasing the goodwill to 17. Okay. But IAS 38 prohibits that.
Okay.
You got it?
Okay, I get it.
So, so now, since IAS 38 prohibits this, this 5, okay, will be taken to the profit or loss account, okay?